Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at how to possibly unlock some long-term value, and we're looking at three S&P 500 stocks to consider buying on the dip. And those three stocks are SBUX, Paycom, and Public Storage. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our portfolios, services, and more. So before we get into the three S&P 500 stocks to consider buying on the dip, we're going to go over the broader market just to give a sense of maybe why we're looking at these three stocks. So higher rates still haven't made their way into as much of the economy as Jay Powell and the Fed would have hoped. And some of that is to do with the fact that many people bought their homes when rates were at rock bottom levels in 2020 and 2021. And meanwhile, baby boomers are selling their homes, many of which were paid off, and then making cash offers in new places to start living their golden years in style. On top of that, the U.S. job market remains pretty strong. The unemployment rate hit 3.8% in August versus 3.5% in July. But a large chunk of that gain was from an increase in the labor force participation rate. So more people just actively entering the labor force again. And all of this has more and more people on Wall Street banking on that soft landing for the U.S. economy. Goldman Sachs, once again, earlier this week, lowered its U.S. recession odds to about 15%. Meanwhile, oil prices are rebounding. Some of that's to do with production cuts in Saudi Arabia and Russia, so they're extending those cuts. But with oil prices back at nearly 10-month highs, that's not all to do with just production cuts. That doesn't really scream global recession, and this is even with a slowdown in China. So with this all in mind, we should stress that Jay Powell and the Fed are near the end of their tightening cycle, even if they're going to have to keep rates higher for longer than people would have expected or hoped for. But as long as they're at near the end of their tightening cycle, that's what Wall Street cares about. And the earnings outlook, which is the other major driver of stock prices over the long run, for 2024 and 2025 is flat out strong. We're calling for 11.8% revenue growth or earnings growth next year in 2024. This is based on Zacks estimates, and then about 11% higher earnings in 2025. So just really impressive growth after a slight down year this year. That said, the bulls are going to have to keep fighting for control of the market right now. So the S&P 500 and the NASDAQ are back under their 50-day moving averages. I'm recording this on Thursday afternoon, and stocks were, the S&P 500 was down about 0.3%, and the NASDAQ was down about 1%, with those downturns looking slightly better than it was Thursday morning. So that 50-day moving average is the line in the sand to kind of hold for now. The next major catalyst was likely going to be the August CPI data release, which is on September 13th of next week. But with all of these concerns and possible more selling in a historically weak month of September and volatility, investors might want to consider that this could be a good time to take advantage of one of Warren Buffett's kind of most used mantras, and to be greedy when others are fearful, and start looking at some of these large cap S&P 500 stocks that have fallen out of favor in 2023 and are trading at levels that might look like flat out steals years from now. And the best investors like Buffett and many others utilize downturns in individual stocks, sectors, industries, or the entire market as a chance to buy into stocks, no matter really what's happening in the economy or on a daily basis, because they have confidence in the long-term health of the U.S. stock market and the economy over the long run. So with this in mind, we're going to dig into three beaten down S&P 500 stocks to consider for long-term investors. And remember that some of the best times to buy stocks that are going to be winners for your portfolio in the long run is when seemingly no one else does. And this obviously isn't true for random names you've never heard of, but the three stocks we're looking at today are pretty established companies that boast impressive businesses and have strong outlooks. So we're going to dig into these three stocks at the moment. So the first one up is SBUX, which trades under the ticker SBUX. Doesn't really need much of an introduction. It's a coffee shop powerhouse, boasts around 37,000 stores worldwide. It's one of the most valuable brands in the world, consistently ranking in the top 50. The company opened about 600 new net stores last quarter, with about 51% of their total stores company operated and 49% are licensed. So at the end of Q3, the US and China comprised about 61% of the company's total global portfolio, with about 16,000 stores in the US and over 6,000 stores in China. So the two biggest economies in the world have a majority of Starbucks locations. Obviously, the big presence and growing presence in China might have some investors nervous, as we mentioned a little earlier, that the Chinese economy is slowing down, but we'll get into that a little bit later. The company has grown at a really impressive clip over the last 20 years, with the only two downturns in terms of year-over-year revenue declines coming in 2020 and 2009 for obvious reasons. The firm has gone all in on e-commerce and its app and delivery and other digital initiatives, as everyone else in the industry, from McDonald's and Dunkin' Donuts to Chipotle and everybody, is going all in that direction. So in terms of the most downloaded food and drink apps in 2022, Starbucks came in fourth behind only McDonald's, Uber Eats, and DoorDash. So in terms of individual stores, only McDonald's was ahead of it, and then Uber Eats and DoorDash are those places that will deliver all different kinds of food. So that gives a sense of just how popular Starbucks is. And that was worldwide app downloads. So the company topped our Q3 FY 2023 estimates in early August, with its adjusted earnings up 19%, and its global comparable store sales were up 10%, driven by a 5% increase in transactions and a 4% increase in average ticket. The company also noted its rewards loyalty program of 90-day active members in the U.S. increased 15% to over 31 million, which is a huge boost for the company, because those people who are on those loyalty rewards keep coming back and back and back. The company is also actively working to improve its stores and how they operate under its new CEO, who took over back in March. They're installing new ovens and coffee machines, and baristas are staying at their jobs for longer, which is a great sign for the company. They want to boost their supply chain as well and improve just other overall experiences to make the store experience better for customers and employees, as I said, just to retain people for longer, because it is a relatively hard job when people are ordering these crazy different orders and things like that. And it can be very busy if you've ever been into a Starbucks, and overwhelming at some points. Going forward, the company thinks that it can start opening smaller stores or stores in smaller cities in the U.S., and its delivery sales are growing, and Starbucks will continue to invest in that to-go order business as well. China, as we mentioned, is a big market for the company, and it's Wall Street's worried about the slowdown in terms of the overall economy slowing down and consumers cutting back on spending there. But if we looked at the most recent quarter, its comparable sales were up 46%, driven by a 48% increase in comparable transactions. Obviously, this was against essentially like a lockdown period still last year in China, but overall, it's good to see people bouncing back, and the economy is still growing in China. It's just not growing at the rapid pace people had been used to. So if we look ahead to what we're calling for 2023 sales to climb 11% to nearly 36 billion, and then jump another 11% to almost 40 billion in 2024. So just really consistent top line growth. And then we're calling for about 17% adjusted earnings growth this year, and then another 18% adjusted earnings growth next year. So really stable and impressive growth. And this comes on top of 11% revenue growth last year, and then 24% revenue growth in 2021. So despite people worried about the economy slowing down and consumers pulling back, their growth outlook clearly doesn't represent that. People are still spending on the little luxuries, and we should always remember that higher income customers who tend to go to Starbucks more often aren't really feeling the impact of lingering inflation as much as people would say, and the job market's still doing really strong. So overall, Starbucks stock's up about 1,200% over the last 20 years. Versus the S&P 500, it's roughly 350% climb. The stock is now up around 150% in the past 5 years to actually trail the benchmark, and it's now trading about 25% below its peaks and 21% below its average DAX price target. In terms of its technical levels, and that's going to be true for all three of the stocks we look at today, it's not sitting in the most advantageous spot, but that might be a reason why people are might consider putting it on your watch list or getting in at these levels. So it's trading below its 200-day and 50-day moving averages. But if we look back, it's possibly ready to find support at its 200-week moving average. And we recently saw that its 50-week moving average crossed above its 200-week moving average. So that's that like longer term golden cross where the shorter dated moving average climbs above the longer term trend. So it could be in a longer term upward movement of these longer term, as I said, moving averages, even though it's sitting below some key levels at the moment in terms of the shorter dated 200-day and 50-day moving averages. It's currently trading 36% below its all-time highs and 10% below its 10-year median at 23.8 times forward 12-month earnings. So overall, if you look over the last decade, it's trading at really impressive valuation levels. And people might want to consider Starbucks stock at these levels at the moment. Obviously, maybe people want to see it climb back above some of those key moving averages, but some of the best times to buy these longer term stocks is when seemingly no one else does. It has clearly come back off its lows from last fall, along with the rest of the market, but it's taken a hit again more recently. So certainly worth considering Starbucks if you're a longer term investor. And now the next stock we're looking at is Paycom Software, which trades in the ticker PAYC. It's a cloud-based human capital management software firm, and it boasts that it's one HR and payroll solution for managing employees from recruitment to retirement. So there's lots of other companies in this wider space, but it's one of those things where once a company has these kind of platforms, they're never going to go back from it. So the company launched back in 1998 as one of the first web-based HR payroll technology companies. Paycom transforms the workplace, kind of giving employees direct access to the data and an easy-to-use application. Overall, they do everything from payroll to talent acquisition, talent management, HR management, time and labor management, tons of different solutions. Its offerings have become so embedded and essential in companies that few want to ever stop using them, which is a good thing. It's also its growth shows up with that. So it has grown at a really impressive clip over the last, if we just say, look at the last 5 years, it grew 30% in 2022, 25% in 2021, 14% in 2020, 30% in 2019, and this is on the top line. So really impressive growth. It topped our Q2 earnings estimates and raised its 2023 view back in early August. And its CEO said at the time that it strengthened its product set and expanded its total addressable market into larger North American organizations with both domestic and foreign employees. So that's a good sign that's getting after bigger clients. Second quarter revenues were up 27% year over year. So looking ahead, we're calling for another 25% revenue growth this year, and then another over 20% growth next year. Just a steady top line growth to get all the way above $2 billion for Paycom. And then on the bottom line, we're calling for 25% growth, adjusted earnings, and then another 20+% growth next year. So just really impressive double-digit growth continuing on for Paycom. It currently lands as Zacks ranked number 3 hold, but it boasts a pretty strong history of earnings beats. And its overall earnings outlook has slowly continued to trend up for 2023, 2024, and 2025, but nothing impressive recently. So that's why it has that number 3 hold at the moment. So the stock's up around 1,600% since its debut back in 2014. This crushes the Zacks tech sector's 250% climb, and it's now neck and neck with the Zacks tech sector over the last 5 years, up around 82%. The stock is not sitting at the best technical levels, as I mentioned when we were talking about Starbucks, that all three of these stocks are trading below their 50-day and 200-day moving averages, but it recently completed the golden cross where the shorter dated moving average climbs above the longer term trend, and it trades 32% below its Zacks price target and nearly 50% below its own highs. It's still not cheap in terms of forward earnings. It's trading about 41.5 times forward earnings, but that's 40% under its historic median and 70% below its highs. And then if we look at its PAYC ratio, which factors in longer term earnings growth, it comes in at 1.8 versus tech's 2.1. This also marks a nearly 70% discount from its own highs. So valuation looking strong as well. The company earlier this year also announced that it would start paying a dividend, which is impressive. It's currently yielding about 0.5% at the moment, which is a nice boost to go along with this growth outlook. And it shows just how stable the company is, that it's able to grow these 20% of the top and bottom line, expand its offerings to bigger businesses, and start paying a dividend. So certainly worth considering Paycom at the moment as well, despite some of its technical levels. And then the last stock we're going to look at is Public Storage, which trades on the ticker PSA. Public Storage is one of the largest owners, operators, and developers of self-storage facilities on the planet. Nearly 3,000 facilities in the U.S., almost 2 million customers. Public Storage is a REIT, and it's been gaining serious momentum for years as Americans continue to buy more and more stuff. I'm sure either you or someone you know just has lots of stuff. Someone probably has a storage facility, even if they have a lot of space at their house or in their garage. Even if you live in a big city or a rural area, not that hard to spot either a sign or an actual self-storage facility somewhere. It grew its revenue at a really impressive pace over the last 20 plus years, including 22% sales growth in 2022 and 17% growth in 2021. And if we look ahead, we're calling for another 8% revenue growth in 2023 and then another 6% growth in 2024, which would actually mark higher revenue growth than its pre-COVID era. So still growing at an impressive clip, even against that strong year-over-year growth during that COVID boom when everyone was buying so much stuff and moving. And its adjusted FFO, which is essentially earnings for REITs, is projected to climb by 5% both this year and next. And its bottom line revisions have stagnated recently to help it grab a Zacks hold, but they're trending upwards over the long haul. It also flexed its financial firepower earlier this year when it lifted its dividend by 50%. And this was back at the beginning of the year. It's yielding about 4.2% at the moment. Overall, its shares have surged about 600% over the last 20 years versus the S&P 500's 350%. This includes some period of sideways movement. So if we look back, the stock's currently trading where it was at one point all the way back in 2016. It kind of stagnated between 2016 and then it dropped during COVID when everyone was falling. And then it finally broke above those 2016 levels on that big COVID comeback. And now it's currently trading about 35% below its highs and 24% below its average Zacks price target. And then like all the other stocks on the list, it's trading below its 50-day and 200-day. Moving averages, it's also below its 50-week, and it's now right below its 200-week moving average. So these are not, as I said, if you're really focused on these technical levels, you might not want to touch any of these stocks until they climb back above. But the downturn coupled with its solid earnings has it trading at its lowest level over the last 10 years in terms of forward earnings. So it's trading at 15.5 times forward earnings, which is 45% below its highs. And it's, as I said, its dividend is impressive at the moment. And I think I might have said its dividends yielding 4.2%. It's actually yielding 4.5%. So people are going to keep buying stuff and they're not going to have anywhere to put it. And Public Storage is a name that you might want to consider along with both Paycom and SBUX as stocks that have not been able to find much love recently on Wall Street, but are possibly longer term names that you want to consider buying at the moment, even if they face more near-term headwinds. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.